Oh, sorry. What's the other one?
All right, happy Friday, everybody. It is Groundhog Day, right? So how does it feel like in real estate? Does it feel like Groundhog Day in real estate? Jackie, sounds like you had a good couple days in real estate.
Well, I did, and look, due diligence ends today at 6, so we'll
Oh,
know
nice,
one way or the other, right?
nice. Well, you'll make it happen. So, all right. So just going to go through some of the numbers, and it's quite interesting remember, these are January numbers. All right. So here we go. Let's start with price. So here's entire MLS median price. Look at that, up 7.6%. So 7.6% is from, remember, this is year over year. So this is January 2024 compared to January 2023 when we were 389, 390. So up 7.6%, but look at historically how high this is. So we are matching May of 2023, we're matching June of 2022, and we're only behind May of 2022, right? So essentially, except for this 1 month, this is the highest price that Charleston MLS has ever been. And what's phenomenal about that is this is January, right? So let's look back, right? Here was May and June, not January, because where is January usually? January is usually fairly low. So look at January 2023, we were here, and you can see the seasonality. And then here we were way down at 360 back in 2022. So you can see January is usually a low. So what's that telling us if January is almost as high as we've ever been? What do you think's coming? I mean, I don't think we can avoid it, right? Here we go. Like we're going to, and I've been trying to dissect this. And usually you can see, and I know COVID kind of made some things look funny, but you can kind of see the seasonality right here, right? And I know I've said this a lot of times, but I can't help but reiterate, from the low, in a typical year, from the low of the market to the high, the market usually goes up 10% in Charleston. The low being the seasonal low, which is typically January, February. Then we go up 10%, and then we fall off 5% the rest of the year. And it looked like it was happening until right here, right? And then the last 2 months have been opposite of you would expect seasonality to come down this way, right? But what happened? It went up. What happened right here? What happened?
No
Rates went from
interest rates.
Rates went from 8% to 6.5, 6.75, right? So you had this bump in volume and transactions and prices, because all of a sudden, almost overnight, it became more affordable. So you had people shopping at 8% all of a sudden react right here when they were 6.5 to 7%. So it is very unusual to have pretty much the high of the past 12 months be in January, right? Because I mean, essentially it's the same number, right? 420, 419, and 6. I mean, it's the same number, right? So we are at a high tied with this since the summer of 2022. So this is telling me look out spring, summer, because I think we're going over this number and we will set all-time highs. And I'm going to spend a little time on price right now, because what you need to do, like, to me, it's like, take this information. This is Charleston as a whole, right? 7.6 is really strong. I mean, that's much higher than the normal year. Now, what's interesting is if you group 12 months together, so when you go to rolling 12 months, is grouping 12 months together, it's 1.5 as a 12-month basis, but a very significant increase. And you can kind of see prices have been flat, relatively flat, since interest rates peaked out. But what I'm trying to point out is these last 2 months are very anti-normal seasonality. It's going the opposite direction it should, which means to me, if we're going up from the low 10%, I think we could hit 440 this spring, summer,
Mm.
right? I think we could get up to this range up here that we've been. So what I want you to do, the areas that you work. So I was messing around with this morning. Let's go look at different areas. So remember, 7.6 is the number Charleston as a whole. So I look at Daniel Island,
Yeah.
right? So Daniel Island is negative 7%, right? But you can see the seasonality. Now, you have less sales in Daniel Island than the Charleston market as a whole, obviously. So you have a lot of, when there's not many sales, you can get a lot of this kind of jumping around. But in general, you can see the mountain here, right? You can see the seasonal up and down. This is kind of what I would expect to see. And you can see it in 2022. You can see it in 2021, right? So here's the normal seasonality. So Daniel Island is negative. And again, part of it is you got a lot higher end product. You got less sales, so it can tend to jump around. But the one that blew my mind is, check this out. If you go city, let's go. And again, I encourage you to go pick the areas that you work. Watch this. Here's Mount Pleasant. Ready? Look at that number.
Wow.
26.7%.
Oh my goodness.
So 886,750 was January's median sales price. Last January, it was 700. Right? This is, I'm still trying to digest this and analyze it, but that kind of shocked me. And you can see the seasonality happening right here, and then it just stopped, right? And it went straight the other direction. But what's kind of eye-opening is we were 700 last January. What we were in February, we're 651. So we went, our next month,
We're opposite that now. We're going to be going.
our next month might be higher. Our next month might be higher, and this was lower. This number might actually go up. Right? And 26.7, that's astounding, because that wasn't even happening in 2021. Right? So I'm trying
Anton,
to,
what's the number of sales doing, the volume?
so the volume, so if we go to dollar volume Mount Pleasant, it's up 38.4% from last, remember this is from last January.
So it's up
So
higher. Okay.
it's up even more, which means the price, it's a price and number of closed sales. So here's closed sales up 8.2. So you have up 8.2 plus price higher equals a lot more volume.
So it's much
So-
more price higher given
Correct.
how low yeah.
And again, when you process this, and I've lived in Mount Pleasant for 26 years, and when you process, I bought my first house here at 149. It was a brand new house. And so when you process that the median price is 886, I mean, we're approaching $1 million median price in Mount Pleasant. I don't think we make it there this year, but watch out next year. Maybe we do. So again, it's eye-opening how dramatic this has jumped. And again, we'll see what happens over the summer when you have spring, summer, when you have more sales, but it's hard to find much, when you look at the prices in Mount Pleasant, this is the normal price, as hard as it is to believe. So let's go back to, we'll just do all the areas again. So if we go to all areas, I mean, 7.6% was pretty impressive. And then I looked at Mount Pleasant and I'm still trying to figure that one out. But so 7.6%, look at, and I mean, Jackie, you had 7 offers on your house in Mount Pleasant, right? Last week, right? This past week. So there you go. What do you think is happening to prices if you have 7 offers? They're going up, right? So here's,
Is there a big difference with properties over $1 million?
as far as the number of offers and
Yeah, or even in just pricing in Mount Pleasant in particular, just because I have a listing of.
That's a good question though. Is it
And
increasing just as much at that price level?
yeah, and I see, and it's hard to like break the price point and see price because you're kind of, it's, you want to look at number of sales and showings and stuff, but I see houses sitting but then I also see houses that get 7 offers. So it's a really strange market to digest right now. You have houses that you think would sell and they're sitting, but then you have houses that get 7 offers. So it's almost like each market is independent. I mean, look, Daniel Island was -7%. Charleston's up almost 8%. Mount Pleasant's up 26%. I mean, it's like 3 different markets. So you really kind of have to look at specifically maybe the area, price point, and again, looking at price per square foot, 8.8%. So a little bit more than, kind of the median price difference, but still higher and almost as high as we've ever been. September we were 226. So it's just very unusual for everything to be at a high in January. And that's telling me like if that's usually our low on the season. And if you're at the high, I think, things are going to go higher. Percent of a price. So, and you can see the seasonality here too. Yeah, forget COVID time. Like this, you got to go further back. You see the normal seasonality back here. Here's COVID. And then the big drop off, big run up, big drop off. But I feel like we're about to turn the corner again and go back up.
Can I ask where Jackie's sale was in Mount Pleasant and price point?
Water's Edge. So
Okay.
single family home, and what was it, 650, Jackie,
Eight-
somewhere around there?
Six, that's why I
We
got so
listed
many.
it, we listed it at 635 and we got more than that, but
Yeah. You listed smart though. Wow.
But I mean,
Yeah.
think about single family homes under 700 in Mount Pleasant. They almost don't
Right.
exist. And if they do exist, you get 7 offers.
Especially near the connector.
Correct. Yep. So here's, we got up to 100%, which I believe we can probably get back up there this spring, summer, but this is probably at the low. It's probably about to turn. Days on market, again, this is normal seasonality. I think we're probably close to the high, and you're going to see this come back down to the, week to 10-day range over the spring and summer. Months of supply. So this is really eye-opening. Look at the months of supply, right? So November, we hit 2.3. And again, this is usually seasonal, right? With the low being over the spring, summer. So if you go back, even the COVID years show this, right? High in the winter, low spring, summer, and again, there was a lot of, let's go back a little bit further in time, maybe 5 years. So again, you can see the 4 months was kind of normal for 16, 17, 18, 19, got down to 0.7 months, back up to 1.7. But if we zoom in, look at the last couple months, right? So we dropped from 2.3 to 2.1 to 1.9, and that's what's driving the prices, right? We're losing inventory at the same time gaining buyers. And that's what's jumping prices and lowering this. And typically, as we head into the spring and summer, especially early spring, you're typically going to bottom out early spring and then come back up as people list over the summer. But I mean, this is under 2 months of inventory. Until COVID, this had never happened before. And now this is where we live, right? This is almost feels like this is normal. But that's going to drive prices up. And if you look at, right, so 5 point, we're up a little bit from a year ago, but 1.9 months of inventory. And if we're looking for a relative reference, if we go and we say Mount Pleasant, right? If we go to Mount Pleasant, come on. Look at that, 1.2. So there's barely over a month of inventory in Mount Pleasant. That's why prices are jumping, right? I mean, this, again, and I've said this before, if I go to a market and you're only allowed to tell me one piece of information, I want to know this piece of information. How many months of inventory? Because that combines supply and demand, which this is going to reflect on prices, right? And if you go back in time, I mean, 1.2, we had 17 months of inventory in the recession. 17 months, we have 1.2. And even pre-recession, we got down to 2. We're almost half of that. So, and the normal range was kind of around 4 in this range here. So, you know, from an aspect of we're living down here now, and is this kind of where the market is? You know, is this like our new norm for the Charleston area? I mean, we've been living in this range for, look, 2021, 22, 23. What do you think 24 is going to look like? Pretty much like that. I mean, that's 4 years in a row. We're kind of living in this very low inventory, high demand range. So this is interesting that we've kind of, again, that's Mount Pleasant. But I mean, even all the areas, 1.9 is extremely low. So watch this as we go forward. Homes for sale. So what happened to homes for sale? Right? Uh-oh, here they go. Bye-bye. Right? They're disappearing again. And disappearing, you know, again, yes, there's people listing, but they're getting absorbed just as quick as you list them. So, I mean, I'm looking at our account this morning and it was 2885, and that's lower than it was last Friday. And it's lower than, you know, it was at the beginning of the year. So best case scenario, we're just trying to hold the inventory that we have. And then if you look at, let's go, and I know I'm using Mount Pleasant as an example, but it's just such a dramatic difference in how much inventory is out there. So look at Mount Pleasant as a whole. So Mount Pleasant, we have 188 homes for sale, 16% less than a year ago. So, you know, inventory is dropping in Mount Pleasant faster than other areas. Part of it's probably because there's nowhere to build new construction. But still, this number is extremely low, half of what we were pre-COVID. I mean, we really need 5,500, 6,000 homes. You know, and again, I want to put a perspective, and I share this with people. We have 2,800 homes for sale. Look at the recession. We had 12,000 homes for sale. Right? So we've gone from 12,000 homes for sale to 2,800. But also think about it for a second. We have 50% more people living here. So
Right.
50% more people with a quarter of the inventory.
And there's more coming. Like we're the number one state people are moving to.
Yeah, and again, it's so dramatic. The difference. Anybody who says we're in this bubble and waiting for prices to come down, it's like you're gonna be waiting a long time. You're probably not buying a house. It's just like you better get on. I mean, and again, you know, the important things is if you own a house, you're combating inflation because it is a fixed payment. You know, as long as you get a 30-year fix, it's the best way to fight inflation. It's the most expensive payment you're going to have, and it is fixed. And equity, you know, prices are going to continue to go up if the inventory is this low. There's no other option. I mean, everything's driven by supply and demand in the end, right? And that's your months of supply. So, you know, I don't see where prices are coming down. Homes for sale, again, falling off. Closed sales, kind of flat from a year ago, right? But keep in mind, the January numbers, a lot of those might have been written when rates were 8%. You know, wait until we fast forward a little bit. So I wanted to put this in perspective, and I'm going to skip this next chart and go to pending. So you have 1.6% higher in closed sales. Look at the pending sales, 16.3. Look at that jump, right? So here's what's going to happen is if pending sales are up 16.3, eventually closed sales are going to jump, right? They're correlated. So this big jump, I think we're going to reflect. And are we going to have more sales than you know, we did 1781 in March of 2023? I mean, at this pace, I think so, right? I mean, if we were 1596 in January, and we were 1372 last January, that's telling me March is going to be higher, right? So that's hopefully telling me we've bottomed out on transactions. And again, you can see the trend in transactions, 2367. If we go to March, right, 2367, 2026, 1781, right, progressively down. Hopefully we break that trend, right, as real estate agents. Hopefully break that trend and we can break out higher and then follow that from there. And I mean, you look at the Januaries, 1940, 1781, 1372, and finally higher. So 3 downs, 1 up, right? So hopefully we are ending our kind of sag on closed sales and turning that corner. And if we flip back to new listings, look at that. So closed sales 1.6, pending sales, pending sales 16.3, new listings 21, progressively higher. I wish they would switch these two, right? Or do new pending close. I don't know why they have it in this order. So up 21%. Again, more inventory, but getting absorbed. And the whole thing is, if you provide more options to the buyers that are sitting on the sideline might be more willing to react and buy a house. So this 21% isn't necessarily bad for the market. We need more inventory for more people, you know, to have choices.
Anton, how's that
yep.
compared to new listings a year ago?
So 1,800 to January, we're at 1,488 last January.
No. Sorry, the year ago relevant period. So 23 to 22.
So 22 in January, we had 1,730. So we're higher than 2 years ago.
And
Lower
we're down. And no, last year was lower.
Right.
Is
So
that
we were still going this way
Yeah.
down, and
So we're
now
jumping.
I feel like, and I think I said this a few meetings ago, I feel like the first quarter was going to be the bottom and turning it around. And if you look at closed sales, so this is, right, this is what matters to us as real estate agents. And if we do rolling 12 months, so you get rid of that seasonality. So we're still off 12.9% on a 12-month basis. But if you work your way backwards, it's like, and they don't have 9 months, but if you have 12 months, 6 months is 4.2 negative. 3 months is 2.1. And 1 month, oh, look, it's positive. Right? So if you go from 12 to 6 to 3 to 1, and it progressively goes from negative to positive, that shows to me we're bottoming out. Right? And we have bottomed out. If you start turning positive, that means you've bottomed out. And again, the reason I'm spending some time on that, this is what matters to us. You know, we were doing almost 25,000 sales in June of 2021, right? Almost 25,000. And then we got down to under 17,000, right? But I expect this is where you can see it, right? You can see we're trying to find that bottom. And I think the first quarter is it on a rolling 12 months. And this telling me year over year is actually plus 1.6 is showing me probably December 31st was the bottom, right, of closed sales. And we will hopefully progress higher from there.
Is this a function, do you think, more so of the interest rates now being back in sixes, psychologically people getting tired of waiting,
Yep.
and or new construction? How's that split with new construction look?
Yeah, and so if we go to the new construction on closed sales, so here, this is all construction is 1.6, new construction's down, right? So we've flipped the whole thing from a year ago. New construction was up, resales were down. Now the net is we're plus, new construction's off, and previously owned is up. So we've actually completely flipped the script from a year ago. Because a year ago, if we looked at it, new construction was up 4% and resales were down a lot. So we've kind of turned that corner where now people are buying resales, I think, and partially because they're probably forced to, because they don't have the, I mean, look, in some areas you just don't have new construction. So I feel like this, we're going through this bottom right now on closed transactions. And, you know, look at dollar volume, right? So this is previously owned up 19, almost 20% on dollar volume previously owned. And then new construction's up 3.5. Well, it's still good, but look at the previously owned, almost 20%. So all construction types is up 15%. So our volume has bottomed out. You know, if you go to the rolling 12 months, it definitely bottomed out, right? And it bottomed out, looks like last summer, right? So we came off the high, looks like we've hit a bottom, and it looks like we're probably going to trend higher, which again, this is good for real estate agents, is like dollar volume matters. Let me go back to monthly, all construction. So shows depending, 10 show, and again, this is a number that it doesn't really matter what market you're in, right? Go back as far as showing time has, you're right around 10 to 12, right? It doesn't matter what year it is. This is, these gyrations are really relatively insignificant. If you get to 10 to 12 showings, you should have a contract. It's as simple as that. Jackie, do you remember how many showings you had on Water's Edge? Can you put your mute off? Yep.
It might have been close to 20.
Yep, there you
But
go.
It was a quick, in 2 days.
Yep. And 20 in 2 days with 7 offers. There you go. So what time of that sounds like spring of 2022, doesn't it? and here we are in January. So so there's kind of tens of number, and then showings per listing. Again, you can see this big bump in January. Now, it's typical that you turn the corner and you have this big rise. Now, I think sellers are a little bit more, this bump up, it's like sellers are good. 20 showings, why do we need more, right? They're not going to let it roll for 5 days and keep piling it up. And I think some sellers, like once they get a few good offers, they pick the best one and they roll with it. So I don't expect this to jump as high as it did in 2022. And remember, back here, we had 900 homes for sale, not 2,800. So we're not going to return to this craziness level here, but it's certainly an active market. So, from an aspect of kind of where we've been and where we're going, it is definitely, this is something to watch very closely. It's like, February is usually, it's a shorter month. Those are contracts over Christmas. It wouldn't shock me if we go down a little bit in price, but watch out for like March, April, May, June. Right. I think we might have just the sideways or down in February, but like, I feel like March, April, May, June, we're going to be hitting this number. I think we're going higher, and we should hit the highest number we've been at in Charleston ever, above even spring of 2022. And then you'll see, I think we're in the process of seeing everything turn, and the transaction count as agents. Again, let me go back to this real quick. So the transaction count, I only had it back here, but let's go way back in time. Right. So pre-recession, we hit 18,000. Recession, yay, we hit 7,700. Then finally, look at how many years it took, right? This is a good 8-9 years of growth. And then finally we hit this 18,000 number again that we hit back here. We finally hit it again. And we stayed there for years until COVID. And then we shot up, dropped off. So we've probably fallen more than we should. But also, this isn't all of a sudden, in 2024, we're not selling 25,000 homes, right? It doesn't work that way. It has to be a growth back up, and it might take us a few years to get back up to this number. So, but what's amazing is like we're under 17,000. We haven't been there since 2016, right? So last year we sold less home, the lowest number of homes we've sold since 2016. So, that's all, keep that in mind. We are at the bottom. So as a real estate agent, you're about to be in this window where we have growth on transactions. And what's the agent count still going to do? It's going to go down. Agent count's going to, there's a time lag. It's so time lag driven.
You mean agents getting out of the business?
Agents get out of the business.
So not new agents
after
coming in? Is that what you mean?
They still get out of the business after the transaction count has bottomed. Like what were agents? So let's go back in time. What were agents doing from here to here? They were getting in the business, right? 2006. Do you think people were getting in the business in 6 and 7? Oh yeah, they were, right? So agent count was doing this when closed sales was doing this. And then what happened right here, when this was was starting to recover, agent counts were still getting out of the business, right? While it recovered. And then what happened here? We all benefited, the agents that were around benefited from this happening while the agent count was a time lag of getting in the business. We peaked out on transaction count in 2021. What do you think happened in 21, 22, maybe the first half of 23? What were agents doing? They were getting
Getting
in the
in.
business, right? So as the
Yep.
transaction count was going down, agents were getting in the business. So right now we're finding the bottom. What are agents doing? Getting out of the business, right? So it worked. And I've done my research on this, and I have my little chart here. Let me pull it up real quick. So just for perspective, and I think this is a conversation not for your clients. This is a conversation for us and the business. So back in, and I have this. So when I got my license, there were about 766,000 agents nationwide, which was 2001. It's off the chart here. That's how old I am, but it's off the chart. So in 2000, and just for perspective, the peak agent count was actually right here.
Hmm.
Like, so look at where we're at on the chart. There were 1.338 million, like right in here, 1.35 million in this time period. So that is about a 2-year time lag after we peaked out. And then where was the bottom? Believe it or not, the bottom count was at the end of 12 at 1 million. So we went down, we went from 135 down to 1 million. Look how long that was, right? Where was the
Yeah.
bottom in transaction count? The middle of 2009. So that was a
Wow.
3.5-year time lag between the bottom transaction count and the bottom agent count. And then if I fast forward and I go, we have had, and I don't have, I'll have to look it up. I don't have the 2023 numbers yet. But in 2022, we had 1.58 million agents, right? So we were still peaking out here. And I'll have to get the 2023 numbers. But I believe the count is still even higher here. And so, you know, I still think there's a time lag that agents just started getting out of the business in 2023. Right. And there's got to be I mean, history proves it's got to be at least 2 to 3 year time lag. So
I
feel
know
like
someone who got in exactly what you're saying, first half of 23, close to the end of it.
Yep. And I feel like we have to 2.5 years of the agent count still going down. And, you know, while the transaction count starts to increase, and I know I've shared this before, my best years were actually right in here. Right. And it's like, well, those weren't the best years. It's like, it's all ratio, right? It's how many transactions compared to how much competition. And when agents were getting out of the business and the volume and transaction count was increasing, I had my license and I was working. And I feel like that's not this year, right? This year, it's like you're still going to have to like work hard, get your transactions, try to save some money, pay your bills. But I feel like 2025 and 2026 are going to be years like this, where the agent count is still going down, but transaction and volume and prices. I mean, if prices start to do this, right? If prices start to do this, by default, you're making like if you did the same number of transactions and the same houses, by default, you're making 7.6% more next year. But if you can take market share and the price goes up and transaction count goes up, you can make 30 to 40% more the next year. Because while agent count's going down, right? So everything is about to point in our favor. Higher prices, higher transactions, lower agent count, right? So those combination of 3 things, by default, if you're doing the same amount of business, you're making more money. If you're doing more business, then you're making a lot more money. So it's kind of like do all your efforts in 2024 that you were doing 2023, because it's still going to be, you know, a year you kind of got to work through it, but then watch out 25 and 26. It's like those can be very beneficial years to be a real estate agent. So, and I mean, I've been doing this since 2001. It doesn't feel like there's any normal year anymore. Just like it's one direction, the other direction. It's like you can't, I mean, I've been through 9/11 in real estate, pre-recession, recession, you know, COVID, you know, post-COVID. It's just, I guess my most normal years were right in here. And it felt kind of, you know, with 4 months of inventory, it felt balanced, but every other year it feels like it's out of balance.
Because it has been.
It has. So it's interesting, you know, Denise, you're asking about the agent count. So it's really, I wish, and I know probably why they don't do it, but I wish Market Monitor would import agent count. I wish that was a tab on here. Because what really matters to us as agents, if you're just looking strictly as an agent, what really matters, and I'll get rid of the seasonality, what really matters to us is this number divided by the agent count. Right? Volume divided by agent count. You know, I can.
Well, it's probably that, you know, the 80-20 rule, right? 20% of the agents produce 80% of the activity, but it really would be interesting perspective to know that.
Yeah, and that's why I kind of use NAR numbers, is because those are published. I got to look up January 31st. So,
I
or sorry,
wonder, what's that software that the brokerage uses? I used to use it to recruit.
yeah, I know which
something.
one you're talking about.
Yeah, maybe
It probably
Vince
has
can
it
get
in
it.
there.
Yeah, I'd be curious.
But this is, and I think this is kind of, it's all pointing to, you know, once you hit a bottom, it takes a couple years and you start going back up. It takes a couple years before people, you know, I hate to say it, but agents probably got out of the business in here when they should have stayed in it. Right? Like right in this window here, the struggles were real, trust me. They were real, and the agents got out of the business and then missed all of this. Right? And I feel like this is a much quicker, like this was a more prolonged rise, fall, steady rise. This was much more pronounced, right? So maybe the window will be a little bit shorter, but I feel like we're going to go through a year or two of lower agent count, which benefits anybody still in the business. So it's all just perspective of, you know, when I've been in the business, it's like, here we go. It's like we're losing agents when the bottom has already happened. And it's just, you know, you got to stay with it and take advantage of the years on the backside of it. And this was so dramatic and so quick. You know, you were just in the right place at the right time. You know, that's what happened here. But I feel like this can be a planned, you know, effort. And it's amazing though, look at how much higher the volume is, other than this in here, how much higher the volume is than before here. But if you look at closed sales, it's actually lower, right? But that's simply because the prices went up so high. And I mean, you look at sales price in Charleston, let's get rid of. So if you look at monthly, right? So for 420, if we go pre-COVID, so the January 2020 was pre-COVID technically. So look at January 2020, we were at 287. So we've gone from 287 to 420.
Almost 50%.
That's phenomenal growth. And again, affordability, yeah, affordability is real if you don't own a house. But, and this is where the articles kind of miss, I think, what's happening is that, yes, if you don't own a house, affordability is a major issue, right? High interest rates, high prices, right? That's an issue for people who don't own a house. But the people who do own a house, they have 71% equity in their homes in the US.
So
Right.
the other day, it's funny. So I don't know. I was with some friends and we were talking about debt or something like that. And I said, well, I really don't have any debt other than my car, which I could pay off. And somebody said to me, well, what about your house? And I said, I don't consider that debt. What?
Correct.
It's not debt.
Right.
I'm
Right.
paying myself. What there's not debt there.
And that's the whole thing is everybody needs a place to live, right? And you're either a tenant or a homeowner. And again, there's two major, conversation topics is to fight inflation. If you're renting, you have no control over what that landlord or apartment complex, what they're going to charge next year. You have no control over that. And yeah, if you own a home, we're dealing with some insurance issues right now. There's some things to deal with, but still, a majority of your payment is fixed, right? A majority of your payment is fixed. So imagine you own a home for 10 years, how cheap that payment is going to feel in 10 years, right? Because I mean, inflation is still going to progress. And even if it gets down to 2 to 3%, it's still going to, you go down 10 years, you're paying 35% more for an apartment. So, I mean, people need to understand it's like they feel like they're missed the boat or interest rates are too high. And sure, you still got to qualify, but the long-term play is you have to own a property that you are gaining equity in, paying down, and fixing your payment. Right? I mean, for the most part, everybody's highest payment is their house. And you have to fix that highest payment. And that's, again, over the long term, this is real estate in the US is like 4.7, 4.8% over the last 50 years. Right. And everybody's like, oh, well, the stock market's 8%, 10%, whatever it is. It's like, well, you still need a place to live. And you're making money, the 4 to 5% that it's going up, you borrowed money on that. So your leverage point is so much higher than the stocks you're paying 100% for that. This you might only pay 20%. And if it goes up 5%, that's way better than the stock market. Right? Everybody wants to compare like appreciation to the stock market. And it's like, well, if you're borrowing money, when you run the numbers and you still need a place to live, it's solving two problems. It's a good investment and you need a place to live. So, and again, we still have this problem coming from a standpoint of rates I mean, I know some people on this call who own a house. It's like, is 6.5% exciting if you own a house at 3%? No, right? It's not exciting. So, but is 6.5% exciting when you were looking at houses last fall when it was 8%? Right? So what's picking up first? And this is what we're seeing right now. What's picking up first? The demand. Right? The demand is picking up before the supply because 6.5 is way more exciting to the buyers than it is to sellers. Because those sellers, you still have to convince to leave a low rate. And some of them just don't want to. So you're not having that. And again, most sellers, so think about your seller list, your seller prospect list. On mine, almost every one of those sellers is a buyer, right? They only want to sell if they can buy the right house. So you're not really helping the supply and demand. You're just one and one. You're just trading off a buyer and a seller. So you're not really improving the ratio. But that lower rates, and I mean, what's the rate that entices sellers to sell their house? I personally think it's mid-5s. Like, you got to get to entice these existing sellers who are at 3, 3.5, maybe 4, 2.75, to really get them excited about moving. I think you've got to get to 5, 5.5 to really kind of move the needle for them, willing to, yeah, we're going to bump our payment, but we've been wanting to make this move. I don't think 6.5 is still exciting to them. Right? I mean, for those of you who own a home, is it exciting to sell your home and buy another one right now? Right? I'm a homeowner. This is my answer. No. Right? So, I feel like we're still going towards this higher demand, lower supply because of the rates. And I just don't see where that's going to change. I think people are just going to be in their houses longer and hang on to their rates as much as hang on to their house. So
I think it's interesting too this year because it is a political year. Like, I think that drives people's sentiment as well.
Yeah, and I think the second half of the year, you're going to see a little bit of a slowdown, I think, in the second half of the year because this happens every election year. There's this pause, but then as soon as whoever wins the election, then people just go on. Like they're like, well, we're still going to live our life. And
Life keeps on going. Yeah.
Yeah, and that's why I feel like 2025 and 2026 get past the election, hopefully inflation kind of settles down. They start to lower the Fed rates, and things will settle down to the point where people have confidence to move forward. And there's so much cash floating around in real estate. It's amazing. I mean, again, 71% equity. It's like, it's not an affordability issue for people who own homes. Housing is not an affordability issue, right? It's for the 33% of the people who don't that it's a problem. And so it's a challenge for those who don't own a home to get into the market, especially, I mean, look at Mount Pleasant, the median price is $886. That's like, do the payment math on that. But it's $886 because people are moving so much equity from house to house. You know, so they're not putting 10% down on 886. They're bringing 80% over. So anyway, that's kind of my points for the day, but it's very interesting to see how much the market is jumping, but all in January, right? In what traditionally is the low month. Remember I said low to high is usually 10%, right? So if we're at the low, 10% is a big number. Now, I think we kind of got a head start this year because of the rates. So I don't think we're seeing 10% from here, but I certainly think we could see 10% from here. So what's 10% from 400? It's 440, right?
Yeah.
So are we going to end up here in June? I think so.
It's less than 5% move. Yeah.
Yeah, I think we're going to be 440 to 450. And you know, we're going to be up in this range we've never been before. And I think that's where we're headed. So, yeah, it's something to see right here going up when we should be going down. So that's kind of a sign, I think, of what's coming our way. So, all right. Well, any other questions?
I do have one
comments?
quick question. It's a
Yeah,
little
Jackie.
bit off subject, but not. Denise had mentioned, and I had heard too, that the Southeast was going to be the fastest growing, you know. Where can we go to find out where they're coming from?
I mean, I would say your moving company websites, like your big moving company websites, have that data, like showing where the moving trucks, because think about it, these moving trucks that are moving from all over the country, if the net inflow is from New York to South Carolina, how do we get those moving trucks back to New York if everybody's moving here and not there? So these moving company sites, I do believe they have data on the movement of, in general, of all their trucks and where they're coming from and where they're going to. I mean,
Okay.
California is still a net negative in population, and that's an affordability issue out there as well as other issues. But, you know, look out South Carolina, North Carolina, you know, Georgia, you know, the whole Southeast is going to be a big benefactor of all that. And again, the high-end properties, I mean, Mount Pleasant's still cheap compared to some parts of the country, right? I think the median price in California is $1 million or higher, the whole state. So I mean, essentially California is Mount Pleasant, right? And so plus you have 13.3% state tax and all these other taxes and everything else. So California is still way more expensive to live than Mount Pleasant, South Carolina. So, but yeah, I would check moving company sites, like the big movers, the nationwide movers.
One of them publishes, when was the most recent? There's that
Yeah,
one
I thought
that
it might
every
be
year.
United has a big.
Yeah,
Yeah, I think they publish it on a yearly basis.
I think it is. You're right. If it's not, it's Allied, but I think it is
Maybe
United.
it's Allied. You might be right. Yeah, check a couple of those big ones. So,
Jackie,
right.
I've also I've
Yeah.
used Charleston Regional Development Alliance. It's been a while since I've looked at that, but
Okay.
it's the website crda.org.
Yeah.
Okay, that's a good one too. Yeah.
I don't know how, yeah.
And that
Are
might
they
be more-
current?
Say that again, CRDA.
Yeah, CRDA.
crda.org.
Do you think their stats are current, Lauren? I think of them as being more.
I don't remember. I want to say it's likely that that they may be having 2023 data, but I don't know. I can't remember.
Yeah. No, but it's good. It's a good idea. Yeah.
All right. Well, here
Thank
we
you,
go.
Anton.
All right.
Thank
Good to
you.
see you, Sean, Lauren.
Thank
Jackie.
You too. Bye.
All right, have a good afternoon.
You too. Thanks. Bye.
Thanks.